They didn't warn you. They didn't ask you. They simply rewired the Federal Reserve while the world was too distracted to notice. Trump's team has already shifted the internal power of the FOMC, replacing dissent with loyalty, turning a once independent institution into a political instrument aimed at one target: drive interest rates back to zero. Because when rates hit zero, the market doesn't just rise, it erupts. And only the people holding assets survive that kind of blast. But how did they reshape the Fed from the inside? And why does ZIRP create both massive wealth and massive casualties? Let's go deeper. They didn't need votes from Congress. They didn't need speeches, debates, or public approval. All they needed was time and a deep enough understanding of how the Federal Open Market Committee actually works. Trump knew that fighting Powell head-on was a losing battle. A Fed chair can't simply be fired, but his power can be diluted. And so the reshaping began, quietly, methodically, with the precision of someone who understands that real control doesn't come from titles. It comes from the people surrounding those titles. Adriana Kugler was the first crack. Ethical concerns surfaced, pressure mounted, and she stepped down early. In her place, Stephen was installed, a far more politically aligned presence. Lisa Cook became the next target. Removing her would have shifted the balance even further, but the Supreme Court blocked the attempt. Even so, the message was clear. This administration is willing to push the legal boundaries of a supposedly independent institution. Inside the FOMC, Powell's authority began to thin. He still presides over the table, still carries the symbolic weight of the chair, but symbolism doesn't move markets. Votes do. And Powell is only one voice among 12. With every strategic replacement, every ideological shift, his influence contracts. Trump isn't attacking the Fed from the outside. He's tightening his grip from within, rewiring the very architecture that decides the direction of U.S. monetary policy. This is how power changes hands in the modern era, not through coups or revolutions, but through appointments, resignations, and the slow erosion of independence. And when a president reshapes the voting core of the Fed, he isn't doing it for vanity. He's preparing for something bigger. The question is, what comes after the restructure is complete? When Powell's term expires in May 2026, most people will treat it like a routine transition. Another bureaucratic shuffle, another face behind the podium. But that view is naive. Powell's exit is the final opening in a long, strategic corridor Trump has been constructing from the moment he began rearranging the FOMC. And walking directly down that corridor is Kevin Hassett, not a neutral technocrat, not an academic purist, a policy operator who already showed his hand when he said, with zero hesitation, that if he were in Powell's seat, he would cut interest rates immediately. Prediction markets don't lie about sentiment. They reflect where insiders place their confidence. And right now, Hassett holds an 86% probability of becoming the next Fed chair. A number so high it feels less like speculation and more like inevitability. His background at the National Economic Council tells you exactly who he is: a strategist designed for alignment, efficiency, and execution. Someone who doesn't posture about independence because he doesn't pretend to be independent. If Powell was the brake pedal, Hassett is the accelerator. And Trump wants the car moving fast. The economy, the markets, the political optics, everything benefits from cheaper money, looser conditions, and a Fed willing to open the liquidity taps with no philosophical restraint. With Hassett in the chair, the Fed will not be a cautious institution balancing competing risks. It will be an engine wired for aggressive easing, regardless of the inflation scars still visible across the economy. This is not the arrival of a new thinker. It's the installation of a loyalist with one mandate: drop rates, expand liquidity, and give the administration the monetary landscape it wants. If that's the direction of policy leadership, then what does the endgame look like when the accelerator is pushed to the floor? While the rails debate plays out, another infrastructure story is moving behind the scenes. Let me introduce Unic, the platform that's changing the game in crypto trading. Unic's OTC exchange has already processed over $1.3 billion in OTC trading volume, giving both buyers and sellers the flexibility they need. With over 5.5 million active users and 500,000 plus followers on X, it's a platform built for scale. Please note that this is not financial advice. ZIRP isn't a policy, it's a worldview. It says debt should be cheap, investment should be reckless, and risk should be rewarded because the government will backstop the fallout. Trump has signaled repeatedly that he wants rates near 1%, and history shows he's not afraid to demand more. In 2019, he asked for negative rates. That wasn't hyperbole, it was a preview. With a reconstructed FOMC and a likely Hassett-led Fed, the road to zero interest rates becomes more than a theoretical scenario. It becomes a strategic maneuver. Labor market softening provides the justification. Risk management cuts, as Powell calls them, provide the narrative. And political pressure, blunt, undeniable, constant, provides the force that bends policy even when inflation remains stuck at 3%. This is where logic collides with ambition. Traditional monetary models would argue for caution. Inflation still clings stubbornly to the economy. Wage growth can't compensate for rising costs. A return to ZIRP risks reigniting the exact dynamics that overheated markets and hardened inequality. But this moment isn't about textbook caution. It's about raw political advantage. Lower rates supercharge asset prices, and rising markets fuel confidence, consumption, and support. Especially in election seasons where momentum matters more than mathematical elegance. The public narrative will be simple. Rate cuts will fix the economy. But the unspoken truth is darker. Zero rates don't fix structural issues, they mask them, they delay them. And when the bill eventually comes due, the bottom half of society pays first. Still, the markets don't care about philosophy. They care about liquidity. And liquidity is about to flood back in levels we haven't seen since the post-2008 era. But what happens when cheap money meets a weakening dollar? A currency doesn't collapse overnight. It erodes piece by piece, policy by policy, signal by signal. Until one day the world wakes up and realizes the dollar is no longer the immovable anchor it once was. In 2025, the DXY slipped nearly 10%, one of the steepest annual declines in modern memory. But declines like that don't come from market whim. They come from uncertainty, political intrusion into monetary policy, and tariff threats that warp global trade expectations. Rate cuts amplify the fall. When yields drop, capital leaves. Investors dump the dollar and chase higher returns in other currencies, creating a loop of weakness, feeding more weakness. It's the same mechanism that once drove the yen carry trade. Borrow the weak currency, buy the strong one, and pocket the spread. If ZIRP becomes reality, the dollar won't just soften. It will bleed steadily as global flows reposition for better yield elsewhere. And when the world's reserve currency weakens, inflation doesn't wait. Oil, wheat, soybeans, all traded in dollars. A softer dollar means importing inflation straight through the nation's bloodstream. Every step of the supply chain feels the pressure. Importers pay more, wholesalers adjust margins, retailers increase prices, and consumers face the final blow. The administration can blame price fixers, and they can sign executive orders targeting food chain collusion, but macroeconomics doesn't bend to political narratives. As Darius Dale pointed out, the real culprit is the weak dollar policy itself, not a corporate conspiracy. The danger isn't just rising prices, it's rising prices in an economy where real wages can't keep up. And if ZIRP accelerates the dollar's decline, inflation becomes a structural force rather than a temporary flare. Quick update on UNIC. Their IDO for the UN token is live. The project markets a low FDV approach, referral rewards, and NFT perks for early participants. They present themselves as an on-chain OTC liquidity layer aiming to capture pre-market and institutional flows. Again, not financial advice. Check the link in the description for UNIC's token page and white paper before deciding. This was never just about Trump or Powell. It's about a power shift inside the monetary system, one that will lift assets and squeeze everyone living off wages. Zero interest rate policy will ignite markets, a weaker dollar will fuel inflation, and most people won't understand what happened until it's already too late. The question is simple. When the liquidity wave hits, will you ride it or be buried under it? For analysis that cuts deeper than the headlines, subscribe to Underworld Capital. Stay early, stay dangerous.